Most people want to invest in real estate. It just is an obvious wealth builder. But so many people just don't have the time. They're already busy with their own job. Maybe they're doctors, attorneys, entrepreneurs, techies, and they're already working a lot. They're already oftentimes working double shifts, but want to figure out a way to invest. Well, in today's show, we're going to talk about how to invest fully, passively in real estate, basically investing in someone else's deal. I'm Kathy Fetke, and welcome to the Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fetke, the real estate investor's resource.
Today, we're talking to Chad Ackerman, one of the co-founders of Left Field Investors, and we're going to dive into his investor story and his philosophy around passive investing, mainly in other people's syndications. We'll talk about the red flags that Chad has identified in this form of investing and what kind of deals he's looking for today. And just as a side note, he often talks about LPs in this interview, and that means limited partners, which many people refer to as the investor in the deal. That's usually limited to limited partnerships. And at Real Wealth, our syndications are held in LLCs, limited liability companies. So investors are called members in our syndications. I just wanted to throw that out there and clarify. So let's get on with the interview. Chad, welcome to the Real Wealth Show.
Thanks, Kathy. Really appreciate you having me on. Excited to be here with you today.
Me too. Our producer is so excited to have you on. So am I. All right. Let's start with your background. What was your professional life before real estate?
So I was in the human resources industry for my career. Specifically, I was focused on sales compensation plans. So I got to work with the sales team, never wanted to be a salesperson, but I loved the energy of working with them. And because I was comp, I was either loved or hated, depending on which side of the quota you were really sitting on any given time. So I usually strap my armor on to go out to sales meetings and stuff like that and take my blows and adapt to them. But it was an analytical role, really, because it was a lot of numbers. It was a lot of analysis. And that really fed when I started looking at real estate, that real estate deep dive, that due diligence that you needed, the underwriting. So it kind of bled over, HR doesn't sound like the standard pathway to get into real estate investing. And it's funny how people get here, but there was enough analytical background in what I did that really fed to me being able to dig into this side of things and get a lot of pleasure out of understanding what deals look like and how to vet them and stuff like that. So it bled over, but compensation was my thing. Yeah.
What sparked the interest in real estate?
It started with a conversation that I had. I changed jobs. I had a new role that had a 45-minute drive time. And there was a coworker that said, "Hey, I'm looking at multiple income streams and trying to find alternatives. And I'm thinking about real estate." And I'm like, I should look into that. I've got this drive time now. I got time to, listen to things on my way to work and on the way home. So I got the spark from her, Michelle, I'll give her credit, that she put the bug in my ear, and I found Bigger Pockets and their podcast and their books, and Robert Kiyosaki's, Rich Dad Poor Dad really got me going too. But it all started spiraling from that it was, I want to learn more. And all these single family shiny objects, and just couldn't figure out how to scale it and make it work while I was still in my W-2, because I enjoyed what I was doing, but I was kind of getting at the end of feeling like I was challenged in this anymore. So I was looking for a way to transition out. In the single family stuff, I just couldn't figure out how to make it work. And I saw friends that were doing it and they were exhausted and their weekends and their evenings were just, I got to run to the rental real quick before we do anything, that I'm like, it never clicked with me. And I found through Bigger Pockets, a local meetup on single family, and started attending it here in Columbus, Ohio. And one of the founders of that meetup happened to be Jim Pfeiffer, who ended up partnering. He got up and spoke one meeting about passive investing. And that's when it clicked with me that that's the avenue I should look at. He and I met him afterwards, stopped him to ask questions, found out we live in the same suburb of Columbus. So, we got together for a beer and started talking about us. And that's when I knew passive real estate investing was my thing. That's what I really wanted to look for.
I love it. I was just on stage with Jim. He
Yes,
is
yes.
so great. We were on the pitch slam where I
Oh
was
yeah,
talking about our new multifamily fund, and Brian
yeah.
Burke was talking about his new medical fund. And going up against Brian Burke was scary. So we had to wear our Vegas glitter to try to stand
Oh,
out a little
nice.
bit.
Shiny
But
objects.
yeah, exactly. Yeah, but the bottom line is we're both timing things pretty well with senior housing for sure, and then in
Yeah,
our case, multifamily has this is a good time to be getting back into that.
seems like it. Yeah.
Super fun to be there on stage with Jim talking passive investing. So I think that's such a great distinction because so often people think of real estate as flipping and wholesaling and doing the work. But a lot of people already have work. They
Yeah.
already have jobs they love. They spend 8 hours going to school, 8 hours, 8 years going to school to learn a certain profession, maybe to be a medical doctor or to be in tech, and they can't be active. There's
Yeah.
just no way. They have to be passive. So, what are some important things that you learned along the way of how to be a good passive investor? Because passive investing doesn't mean you just aren't really active in the beginning, right?
Yeah. Right. No, our phrase at Left Field was you got to be an active passive investor for a
Oh, I
while.
love that. Yes.
That was our story. Until you write the check, you got to dig in and do due diligence. It's an important thing to me. What I believe in still this day, it's being part of community and really getting in to educate yourself. There isn't a lot of education material out there to teach you how to be a limited partner in these deals. That's exactly why we formed Left Field. That's why Passive Pockets exists today. And there are other ones. And by all means, we always encourage people to join multiple of these because you're finding like-minded individuals in those
Yeah.
communities that you can feed off of. We aren't always going to be right. There are elements that you can fall into groupthink if you're not careful that you got to watch out for. But at the same time, you're hearing a lot of due diligence from other people and their experiences so that you can mitigate your risks as best as you can. Every investment has risk. You can't get around it. So I always tout, go find a community to get involved with because you can learn so much more, especially in this passive real estate investing, just because there isn't a ton of content out there yet. Go find good podcasts like yourself. That gets some education out there too, but go get educated. Don't get into analysis paralysis, but get yourself educated before you write a check too
Gosh,
quickly.
you're making me think I need to write my third book on how to invest passively because you're right. You're right. My first book was on how to own single family rentals.
Yeah.
And we had
ton of stuff on that, ton of stuff
ton
on
of
being
stuff.
a GP, not a lot on being an LP. Yeah.
No, it's true. And we've been syndicating for 15 years and there is
Mhm.
so much to it. It isn't really passive at the beginning because
Right.
once you're invested, your job is done,
You're
right? You
done.
can't
Yeah.
really get your money back out.
Right.
Yep.
Yep.
So what are the let's just start with the no-nos. Like what would be an instant red flag for you? Like all my friends are running towards this deal and I'm running the opposite direction.
Yeah, to me, it's the operator that is too salesy, that's promising the 35% IRR and 3-4x return for a multifamily with some light value add. You've been in it long enough, that white hair just doesn't exist out there, kind of thing. So it's be cautious of the over marketing. And the other thing we always encourage people to stay away from is just the whole diversity side of things. Don't put all your eggs in one basket. Diversify by operator that you go. Don't put all your money with one individual. Diversify by asset class. So if everything's in multifamily takes a hit, your whole portfolio is going to take a hit. And diversify by geography is the third that we usually say too. Don't buy everything in Florida and then a hurricane takes out your entire portfolio. So it's watching out for those cautions. There's a ton of red flags. Red flags to me gets very individualized, very personal to your own risk tolerance, to your own goals and strategies you have with your program. I was in a state of trying to get cash flow so I could get out of my W-2. Therefore, I didn't need to go look at development deals and so forth. So I stayed
Right.
away from, I mean, it cut down on the noise a lot for me so
Yeah.
that I could focus on a much smaller filter than the industry is a big, broad thing of shiny objects. So
Yeah.
it was my way to trim that down and get a little more efficient with my process
Okay.
so I could
You had
avoid red flags.
so much I have to unpack in what
That
you
was a
just
lot.
said.
Sorry.
No, it's so good. So let's go back to diversification. This is huge. We have been syndicating, like I said, for 15 years. We are currently have, I don't know, 15 projects. When people come to us with big checks, I just say, don't do a
Yeah.
small check
Yeah.
because we have more stuff coming,
Yeah.
right?
Yeah.
We some deals are going to do better than others. Some are going to do terrible.
Right.
Like you just said, we did a development deal. We didn't know that the entire world would shut down for a year and that we couldn't get to our site or get the materials or get our workers there. That one person shows up sick, nobody can come to work for 2 weeks, come back
Yeah.
to work, someone else shows up sick. It was unpredictable
It
and
happens.
such a great project to begin with, but then that happened, so very, very, very difficult.
Yeah.
Why put all your money in one deal when there's a lot of good deals out there?
A lot of good deals.
My
Yeah.
my husband, Rich, is a business and personal coach. He only takes a couple clients at a time. Used to do it full time, but one came to him and was like, "Hey, I just sold my company. I'm going to put all several million in with this one very famous person." And Rich is like, "Please, no,
Yeah. Yeah.
don't. Why
Yeah.
would you do that? Don't." So he didn't. He put like
Good.
50,000 in and lost it. So he could have
Mm,
lost all of it, even though this person's super well known.
that's too close.
Yeah, yeah. So what do you say about like super well known people? Like,
To me, it goes back to your buy box and your goals. Maybe it's the right fit for you, but I think one of the biggest things you need to get over is fear of missing out. The FOMO
mhm.
is one of the worst things you
Yes.
can have in this industry because there will be another deal. Spreading your money out allows you to meet so many other people, operators, to find that core group. My goal was to meet as many operators as I could and then find my core group that I was going to reinvest with. But I always felt like I had to be testing new operators because operators I love and know, like, and trust, maybe they're ready to retire. Maybe they're ready to step away. Maybe they're ready to shut down. I need a backup plan until I'm ready to shut down, and I'm not there yet. So I tried to strive to find as many operators that I could invest with to watch and learn, because you learn so much more by being an investor with them than just being
Mhm.
on the sidelines tracking it. I wanted to meet as many as I could and then find who I was comfortable with. I say now it's a great time to be an LP because 5 years ago, operators were coming out of the woodwork and everybody was successful because the market was so red hot. Well, when the pandemic hit and then interest rates went up, a lot of them got exposed and they're out now. So you're left with the ones that knew what to do in that kind of industry, were prepared, were conservative, and they're good people to keep investing with. So your funnel has gotten smaller because there's few operators out there that you have to sift through, that you're cutting through some noise that way too. So it's a great time to
Mm.
start. There's I don't want you to try to catch the falling knife. I don't like that logic at all. But I think starting now, I always think there's opportunities to be found. Right now, you have fewer of them to look at because there's fewer operators out there, which I think is great.
Yeah, I mean, a lot of people have lost a lot of money, right?
Yeah,
Over the
yeah.
last couple of years, or probably it's all showing up now. Were you aware at the time that that it was kind of a gold rush, but people rushing into things they didn't understand? Could you see that then?
Um, I think there were certain ones that threw red flags, operators that just started buying deal after deal after deal. Like every other week, it seemed like another offering was coming out. Those tended to be red flag because we saw too many times that people would grow too quickly and didn't build the infrastructure to go with it. And then they would get themselves in trouble. We didn't have a ton of those. I, the one that I think we missed that everybody thought was fantastic was ATMs, and ATMs look
Mm,
great for years. For years,
mhm.
people love that asset class, and then all of a sudden it flips upside down. So it doesn't mean we're right all the time. The group think can get you in trouble, but for 12
Sure.
years, ATMs was a good thing to do. Then all of a sudden, everybody got caught at the same time. So there were some
Yeah.
things that threw red flags, but some of these things just popped up and were a nature of the beast. I'll be honest, I didn't pay nearly as close attention to loan structure as I do now,
Mm-hmm.
because I just ran with the market's hot. These are going well. I
Everybody's
have
doing
faith in
it.
it. I have
Yeah.
faith in it. Everybody's doing bridge loan. That's okay, because we'll
Mm-hmm.
refi. It'll be great.
Yeah.
And then all of a sudden, those bridge debt just got everybody in trouble. Well, we didn't think about that 5 years ago.
Mm-hmm.
Now it's something we pay attention to. Are you sure?
And
You
I
have
did think
caps. What
about
do
it.
you have? Yeah,
You know why I did think about it? Because I went through it in 2008. All you have to do is go through it once.
Exactly.
And
Exactly.
I hate short-term debt. Oh, yeah. No, I would see people doing that, and I know the pain.
It became a crutch. It seemed like,
Mm-hmm.
it was easy, especially for newer operators, to be able to get in, not need as much capital to ask for up front, but you run this risk. What if the rates triple? Who had that in
Yeah.
their bingo card,
Yeah. Yeah. And I take that back. It's not that I hate short-term loans, is you just need to have a backup plan in case things don't go as planned.
Exactly.
Yeah.
Exactly. Yeah.
Yes. Good stuff. Okay. So what kind of deals are you looking for today?
I've always been of the mindset I wanted to pick 3 or 4 asset classes and stick with those, get to know them really well. And I'm still in that vein today. So I'm watching multifamily that is starting to come back. It's starting to have a pickup. I think everybody loves multifamily because
Mm-hmm.
they understand it. Everybody lives somewhere, so they have some concept of it. But I like it. I'm watching. I like triple net lease work a lot too. Mostly, I'm
Mm-hmm.
in industrial, a little bit of commercial too.
Yep.
I've really liked that asset class as well for my cash flow side of things. And it's been pretty steady Eddie through all this economy that's gone on. We haven't seen as much up and down effects to it, which has been nice to see. And that's kind of the structure of those deals, right? Of most of the onus falls on the tenant, not the landlord in those cases.
Yeah.
And then I'm still watching self-storage and mobile home park area. Those are kind of coming out of their heyday, but I think there's still some valid investments in those spaces. I've got some perpetual holds in both spaces that I just love because I've gotten my money back and I'm getting cash flow from them still. But those are it. I had a conversation with a GP a couple weeks ago related to doing marinas. And I was like, well, there's another interesting concept.
Mm-hmm.
So there's a lot of shiny objects that I try to be leery of, but this is why I try to pick like my 4 or 5 and stick with them and try to educate myself on the shiny objects, but stay out of them for a little while until I can
Until you
really
understand.
spend some time on it. Yeah.
Yeah, we have a close friend who owns a bunch of marinas, has been very successful, but I think a lot of people figured that out and prices have gone up dramatically.
Yep.
It's kind of more of an
To me, the marinas are where self-storage was several years ago. It was red hot, a lot of room, a lot of mom and pops out there, but then it quickly, everybody found it. It seemed like, and it changed the whole thing. So yeah, it's interesting.
That's why I loved Brian Burke's model of the senior housing. It's just, that's a new shiny object we don't understand. So yeah. Unless we brought someone on our team who understood the ins and outs. How do you feel about that when you see a syndicator try something new? What do you need to see to give you confidence?
Yeah, we always had the same. We didn't want to be an operator's guinea pig. So we didn't love it when a multifamily operator all of a sudden was doing medical, but it helped us feel more comfortable with it, depending on the team they got to support them in that new asset class. They don't have to be the expert in it if they hired a team. I found it interesting because I've asked this question in our community a few times, and typically we get the answer like, well, yeah, if you hire one expert that has been in the business for 20 years, that's enough for me to say, okay, you've got some expertise. But I had feedback one time, pushback on that, saying, no, one person isn't enough for me. If you hire an entire team that's been in that industry for several years, I feel a lot better about that.
Yeah.
But if you're using your multifamily team with one expert that understands it, that's still a lot to put on one individual to catch everything and everything like that. That I thought, that's fair. That's good feedback. Again, I think it gets back to your personal risk strategy of, is one person enough to consider expertise, or do you need a whole team to get comfortable with it? So it gets very individualized.
Yeah, I guess it depends on how big the fund is. Very, very good point. Love that.
Indeed.
So I also love what you said about strategy. You were looking for cash flow, so therefore you wanted cash flowing assets to invest passively. What do you consider to be higher cash flow?
In my portfolio, it gets into that triple net lease work.
Hmm.
That just cash flows like crazy. Has built-in rent increases every year. It's tried and true. The operator I'm with, they're usually buying family-owned businesses that have been in play for years and years and years, decades.
Hmm.
So the reliability of it has been spot on. That I really enjoyed. I like multifamily, but we saw just multifamily dry up in distributions over the last several years.
Yeah.
Yeah, ideally, I like a deal that's going to cash flow and have equity at the end. I want
Yes.
everything, right?
Me too.
Right? Who
Yes.
doesn't want that? But I lean towards the cash flowing asset classes right now to try to help maintain while I'm not in a full time W-2. I'm doing coaching on the side, kind of thing, to keep things interesting, keep my brain in this business more, and so forth. That's where I lean today.
And when you're looking for cash flow deals, what kind of return are you expecting? Because I know I love triple net lease too. It's just that
Mhm.
because it's so secure, the cash flow is a bit lower.
Yeah, it all depends. The mobile home park that I had,
Mm.
it was like up in 9-10%
Yeah,
cash flow,
those are
which
good.
was pretty
Yeah.
nice. Yeah.
Mm.
The triple net that I've had, it's been 6 to 8 typically.
Sounds
But
right.
again, it's like ballpark, get enough of those, enough money in them in different ones, then I'm getting what I'm needed out of this, if you will, to help me along the way. So it all depends. I was going to go ATMs, and I'm glad I didn't, because
Yeah, I
that was like
didn't.
24%. So it was ridiculous.
Oh,
Yeah,
wow.
right.
But
That's
it's
why
not
people
doing
loved
well
it.
now.
Mm, actually, the group that I knew, I won't name, but they're going to jail. Like Ponzi
Oh,
scheme has come up,
oh,
so
dang.
it's gone totally flipped on its head.
I
Yeah.
think I know what you're talking about.
hmm
Oh,
hmm
man.
hmm
Yeah. And there was a
So
lot of people in that.
a
Yep.
lot of people.
Okay.
Yep. Yep.
Yep.
So
And then the
it's a big
carbon.
question,
Do you
is
remember the
finding.
carbon thing? What do you remember what that was?
Yeah, I looked at that a little bit. It had some benefits on the active income as well, which
Hmm.
seemed nice. But it just, again, it was outside of my buy box of my few asset classes that I really was focused on, that I passed on it. And honestly, I've not really gone back to track it and see how it performed.
Well, that guy's
Uh,
going to jail too.
is he too? Well, there you go. There you go.
So
So
anyway, you need to understand, and a lot of this new techie stuff is hard to understand.
it
So
is.
if you have the money to risk, then by
Right.
all means go risk it. That's what big
Yeah.
shot investors do.
Agreed. You could take a flyer on something that has high risk that might work
Yeah.
out for you, but be prepared to lose that money,
It also
is
might
definitely the
not.
idea.
And it's so funny because a lot of our clients at Real Wealth are from Silicon Valley. They've
Mm,
maybe gone through an IPO, or they just have a lot of money.
yeah.
And one of the things they love the most that we do is entitlement. That's taking raw
Mm,
land and getting, permission basically to build on it. And it's a risky business. And we say that this is a risky business because
yeah.
we rely on city council to approve this. And we don't know if they're going to
Could be
stay on the
stuck.
council. We don't know
Mhm.
if it's going to change, if it's going to be pro growth, slow growth. We obviously look into all those things, but I'll tell you what, that's what our Silicon Valley investors just flood to.
Yeah.
We
Yeah.
we sell it out in one webinar, but it's because of our track record. Our
Yeah.
team is highly experienced in that.
Absolutely.
So it again, and there's no cash flow there. It all comes at the end.
Right.
Yep. So
Well, it goes back to that personal strategy of
yeah.
yours. Are you in a W-2 that you love, and it's high net worth, and so you don't, doctors, lawyers are in the same boat. They're probably not looking to get out of it. They like it. They're just looking for diversification in their portfolio. Well, you can take maybe a little more risk involved in that, because you've got a W-2 that's going to keep paying you, that's going to help burden or take away any burden from losses. Hopefully you'll make it up and you can move on. So it really boils back. I always give this answer on podcasts, like it gets so individualized and boils back to personal strategy, but it's so true. Like this isn't a cookie cutter business. This is, what do you need? Where are you at in your life? That's what,
Yep.
in my coaching, first thing I do with professionals is let's talk about your goals. Let's spend 2 or 3 conversations on your goals, your strategy, so I know how to steer you, coach you, because there's so many asset classes and they fit certain strategies. It helps then, like I said before, alleviate some of that noise by saying, okay, you've picked this avenue, ignore all of this so that
Yeah.
you can focus on what's coming your way. Because you know how the inbox gets, you get inundated with offers that it's hard to sift through what's a good deal, what's not. Well, you
Yeah.
can trim at least asset classes once you know your goals and have good alignment. And then you got something to pressure test against.
100%. And, at Real Wealth, we've got a lot of people, we've been around a while. So a lot of our early investors are older and they don't want risk. They just want tried and
Yeah.
true.
Yeah.
They understand single family rentals. So our single family rental fund, super popular. People want in. Our multifamily fund, they get it. They want in. It gives cash flow. And then, like you said, hopefully appreciation, you get both, but at least there's cash flow, which after going through COVID, I really do love me some cash flow.
Love some cash flow. Love some cash flow.
Yeah.
We think cash flow is great, especially when it dries up and it turns off. It's like,
Yeah. Oh boy.
yeah. No, I think that's great.
All right. Any last, I don't know, tips for our investors who would be choosing a passive syndication, kind of just handing their money over to an operator and that's it, versus owning the property yourself, having the title in your name, the loan and all that, making that transition? Any tips?
Yeah. Biggest thing is take your time to get educated on the benefits of both sides.
Mm-hmm.
I always say lean into learning the tax benefits that are involved in the passive investing side. That was the deal changer to me when I learned about bonus depreciation and my models that I had 30% of, my money going to taxes and I could take that out when I moved to the passive side. Like it was just a game changer to me because it was a big tangible number that we were talking about. But take your time to get educated, but take action. Don't sit on, the analysis side of things too long. You'll learn so much more by taking action. Spend your time on your goals, find out what assets classes align to those goals, and then go take action is what I try to coach. I'm here to help coach people through it to build their confidence so they can get to that point. So if you need somebody to help you out with understanding and stuff, that's exactly what I'm trying to do is give back and help educate people in this process. I love it. I burned my ships. I liquidated my 401k. I moved it all over and everything else. So I don't say that's the plan you should go for. It's just a plan, but I'm here to just try to help coax people through and get them comfortable with it so they can move forward.
Love it. Yeah. All right, Chad, it's been a pleasure to have you here on the Real Wealth Show. Thank you so much. And for all the ways that you help others learn how to do this business right.
Great. Thank you, Kathy. Really enjoyed it.
So if you are a busy professional, but you also want to invest in real estate, but as passively as possible because you're already busy, well, we got you. That's what we do at Real Wealth. We help busy professionals invest in real estate, whether it's through turnkey properties, where we can help you acquire investment properties with property management in place to make it as passive as possible, but you still got to find the property or at least vet it but you still need to do due diligence on the property and you need to get the loan and vet your property manager. We have all those resources for you, but it is a little bit more time intensive. So if you just want to be able to invest kind of like you do in the stock market, but in real estate, that's what syndications are. They are registered with the SEC. You invest with somebody else in their deal. We have our multifamily fund that we just launched. We'll be buying multifamily properties at big discounts. And we're about to launch our single family rental fund. It's our second one. And the first one was so popular, people have been saying, please do a second one. So we are. That's in North Dallas. Again, these are totally passive for you. You do need to be accredited. You could do that by going to realwealthshow.com, Just click on the Invest tab when you get there, and you'll see a drop down for syndications and our current offerings. You can also look at the past deals that we've done, how we've performed, the ones that went really well, like knocked out of the park, and the ones that were a struggle bus. So we have learned through the past 15 years, and we are very focused on what we know works now. So again, to find out more about that, go to realwealthshow.com. I'm Kathy Fettke, and we'd be so excited to have you as a member at Real Wealth, where we offer over 500 free webinars on how to be a sophisticated investor and build your wealth. Again, that's realwealthshow.com.
Views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.